Hey everybody, this is Jose Blasco. We are getting ready to get started, isn't it? A quick sound check, if that's okay. I'd like to confirm that you hear my voice before we get started. So I would appreciate a quick message on the chat box where you would just say a quick hello to everybody. That would basically tell me that you hear me and therefore we're ready to go, okay? So please a quick hello message on the chat boxes. That would be very, very helpful. In the meantime, I will turn on my video stream so I can say hello from the bottom right corner of the screen, as I always do. How are you, Maka? Good to see you. Good to see you all out there. Yep, all good. Perfect, perfect. Okay, so we have 3 seconds to go. Time to get started, my friends. Here we go. We are live, everybody. Welcome to the session. Today is March 31st, 2021. Options with options, isn't it? As always, I love to say it is so true. Options give you options. So we're gonna be looking at market conditions and always be adaptable to those market conditions with the use of various option strategies in order to be positioned in a way where odds are in our favor. That's the plan. Okay, so we're gonna be looking at different types of opportunities out there. Before we start, as always, I am highlighting the disclaimer on the upper left side of your screen so you can read it carefully. And please do so, read it carefully. Do not skip it. Read it all. Every word is important. So I am counting on you to do that. Agenda for today. As always, we just said hello. So hello again. How are you, Christian? We are simulcasting. This is nothing new, but if you are new to the sessions, just know that the session is being broadcasted in places such as YouTube, Facebook, our private room in tradewithufos.com/live. And basically, the fact that we are in different places at the same time produces a little bit of video lags in places. So just be on top of those chat boxes when it comes to interacting with us so we can interact efficiently and have everything work well. How are you, Ahmed? Good to see you. Siderman, good to see you. Good to see you all. Very nice. Also, the other thing about the simulcasting is that while the content of the sessions is the same no matter where, the duration is not the same, meaning that the sessions that we do in public spaces are limited in time, where the sessions that we do in our private room are full duration. So again, if you are a trader looking at trading, like let's say this is a part-time little hobby for you, so probably attending the sessions in the YouTube channel is more than enough. And that's free, by the way. Let's say you are looking at trading more seriously, you are very committed, and you are one of those trading lovers that you never got enough, like me. So then probably it's better for you then to subscribe to our coaching plans on our website so you can access the private room in tradewithufos.com/live and basically be part of the full duration sessions. Let's begin. We'll start as always looking at the market environment. And then we'll review the trades that we have and we'll talk about trade management and so on. And then we'll be aiming to identify new trading opportunities to be executed. That's the plan, everybody. Feel free to interact with me at any time. Please do not be shy. Any question, make sure you phrase it so I can assist you, which is why I'm here. Okay, so do not be shy. So let's begin with the S&P. So I will load the S&P and the VIX to understand our market condition. So what's going on? Well, what's going on is that we went from a down climate to a very undecided climate to the climate to be back to be confirmed. And not only that, now we just got a green UFO that formed today, and price is coming into the red UFO. But because the climate is up, remember, buy on-field orders tend to be added in an up climate, and sell on-field orders tend to be canceled in an up climate, and therefore the red UFO is much less relevant than what we would think. And probably what's going to happen is that some markets are going to start making all-time high. So again, we'll see how well we do with the session today when it comes to the use of our time. But certainly, apart from our classical opportunities that we are running, especially when we do non-directional trading, I would also like to start looking into some directional opportunities to potentially benefit from breakouts of an all-time high and maybe a very strong push to the upside as a follow-up of this euphoria of many people coming in the market with a new all-time high being made. Okay, so again, it's not always the case, but often when the S&P makes all-time high, there are certain stocks that really take off. Okay, the S&P normally is a bit, a bit shyer, if you wish. So if you look at, this time, it made all-time high a little bit and then retraced. Okay, then that time made all-time high a little bit and then retraced. That time made all-time high, was a bit more continuous, but that also retraced a bit. This time made all-time high, but then retraced. So, with the S&P, you see more of a zigzag type of movement, if you wish, which makes sense because it's the average of 500 stocks. But when we look at very specific stocks, often we see this much more continuous push. We had really beautiful trades last year, isn't it, that we caught as a consequence of all-time high. And last year, the world was crazy. Today, the world is crazy. Everything is crazy. So as a trader, to be honest, who cares if the world is crazy or is reasonable for the market to make all-time high or not? I guess we would all agree that it's not so reasonable, but it doesn't matter. If the opportunity is there, and the market does indeed start making all-time high, so certain opportunities with stocks may be available for us to get long and ride a potentially powerful move to the upside. Okay, that's what we get. That's what we have with the market. When looking at the VIX, okay, we can see the VIX dropping 1%. So we are dealing with VIX levels of 19. All of this is pointing at market participants to be calm. There is no huge amount of put buying at this moment in time. If that was the case, the VIX would be higher. So again, all of this is suggesting, and on top of that, we got 3 red UFOs on the VIX, right? So all of this is suggesting that if the market falls a bit, those red UFOs are going to push the VIX down, coinciding with the green UFOs on the S&P, pushing the S&P up. So again, unless something key changes in the marketplace, the markets seem to be ready to have another push to the upside. Okay, that's what I would say when looking at the S&P and the VIX and the climate and the UFOs and everything I've said. So now that we know the market environment and we understand where we're at, let's get to understand the few trades that we have. We have 3 trades that we are tracking since a while, since we put them together, and we have some action to be taken, very likely, and therefore I started with Facebook. I'm also loading OptionStation Pro, so we're going to be able to look more in depth into those trades and so on. So I'm just going to load FB for Facebook. Here we go. Now let's begin with the chart. Okay, so what's going on with Facebook? Well, we have a trade, right, that will conclude 2 weeks from now. That is on April 16. This is when this trade is going to conclude. That's going to be the end of the story. We are 2 weeks away, a bit more than 2 weeks away to get there. And obviously, you probably remember that the original plan of the trade, was a range, a very wide range, all the way from below these green UFOs to above that red UFO, from 305 to 255. Okay. But we saw this very strong movement to the upside on Facebook. Okay, thank God for that red UFO bringing Facebook back to the midpoint, which is, somewhere here, if you wish. That was the midpoint, more or less. Okay. But what happened? Well, Facebook is back to move higher. The climate is confirmed. A new UFO is showing up. So again, we are way too close to the upper part of the range. We only have 1 UFO to defend ourselves instead of 2 that we require when we enter a trade. So again, we are back to a situation where this trade may be in danger. And if you recall, we did an adjustment. I called it a tweak the other day, isn't it? So we did a tweak not too long ago where we took our iron condor and basically we moved the strikes from, let me do this correctly. Yeah, we moved the strikes from, I think it was, correct. Yeah, exactly. From 230 to 25, we move the strikes up to 255 to 50, creating this particular new range. Okay, but now again, price is moving higher. So if I was to look at statistics, okay, using that expiration date, which is April 16, well, now the stats are pointing at we could reach 216 and 273. Okay, so 216 and 273. So where is that? Well, 216 is all the way there. 273 is somewhere here. Okay, so what's going on? Well, what's going on is really not so pretty, in the sense that, again, the upper part of this iron condor is at risk, one more time, of ending up in trouble. Fairmont, how are you, my friend? Good to see you. I'm just noticing your message. So the upper part of this range is again in trouble, because statistics suggest that reaching 316 would be a normal thing to happen. In other words, being above our range, located at 305, it's something that could happen. Okay, it's actually likely to happen. In other words, this trade, it's more likely to end up as a losing trade than a profitable trade. So we got a threat. Okay, and just like we acted with some sort of a tweak last time to minimize the impact, we're gonna have to do it again. Okay, we're gonna have to do it again. So you may recall that when we did this trade, the total credit that we collected was about, I think it was like $75, and we had a risk of like 425. So with doing the tweak that we did, we brought the risk a bit lower to 400 instead of 425, and we brought the maximum profit to be higher, to be 101 instead of 75. So we're gonna have to do something similar again. Okay, we're gonna have to go ahead and close the 250, 255 and sell puts at a higher price. Okay, because obviously if you look at Thinkorswim, where you can see the trade here, okay, and you look at the call side, well, the call side is the one in pain, where you have 308 and 212. So of course the difference, it's like $100 of loss. But then when you look at the put side, 64 minus 50 is like $14 of profit. So the idea is to collect those $14 of profit, just lock it in, and sell new options at a higher price to keep adding more premium, exactly the same action that we did last time. Since we are still inside the range, we haven't broken that range yet, so we are not converting the iron condor into iron butterfly yet, but we are indeed rolling those 255 puts higher to a higher price point to again collect a bit more premium. So what would that price point be? Well, again, statistics suggest that price could reach 273. So obviously we need to go lower than that. And again, we need our condition of minimum 2 UFOs, right? So we actually got already 2 here, so I could go ahead and use that UFO, which is the first one beyond the dotted line. But since those 2 UFOs are so close, right, and we are in defensive mode, so I guess that you would agree with me if I was to point at 265, like the right place where to go ahead and get new puts. So in other words, we're going to be closing the 255, 250, and we're going to be selling the 265 and buy below the 260. Okay, so close the 255, 250 credit spread and sell a new credit spread being 265 to 60. So we are moving everything $10 higher again to accumulate more premium. Okay, let's do it. Okay, let's do it. And if I'm going too fast or you need me to repeat anything, let me know, guys. Since I did it not too long ago, I guess this is understandable. But again, not everybody maybe was in the session live that day. So you guys let me know if you need me to repeat, rephrase, or anything else. So let's do it. I'm going to select the puts, right click, and create a rolling order. Okay. And in this rolling order, so basically by default, a rolling order with use 2 different expiration dates. That's not what we're trying to do. I'm just looking at convenience by using a rolling order, but I want everything to be April 16. Okay, so I'm going to make everything to be April 16. And then again, we are buying the 255 and selling the 250. And then we are selling the 265 and buying the 260. Here we go. So if we do that, okay, we're going to lock in 15 cents of credit. Okay, if we do it at the midpoint, which should be doable. Okay, and I mean, the natural point is 12. 12 to 15 is not too much, and Facebook is quite liquid. liquid. So I guess that, with a little bit of patience, we should be able to get filled at this price. So I'm just gonna confirm and send this rolling order, and we just got it. Okay, we just got it. So the 250 and the 255 are gone. So you can see it's 0, 0. And now notice that I sold the 265 minus 1, and I bought the 260 plus 1. Okay, so of course, now you will see a little bit more pain. Now it says 93 negative, but is that realistic? No. What happened now is that we are in this position. So let me update here. 265, 260. Okay, and now, we had collected $101 of credit. So guess what? We just collected another 15. So it's a total of 116. Okay, so what happens now? Well, now if we get stopped out, we're going to lose 384, which is less than before. Now, if we are right, we're going to make 116, which is more than before. So again, we keep tweaking this trade to minimize the problem, knowing that this trade is not looking good. And therefore, we will very likely at some point, based on probabilities, we will go ahead and have to roll it and convert it into an iron butterfly, which that's going to be a different story that will bring in a greater amount of premium in most of the cases. Okay, so we will do that when the time is right. But so far, that was the action to be taken. We've done it. So again, managing this iron condor since price action, it's not as expected at the beginning of this trade, where we expected this market to be ranging quiet and nice, but it's not the case any longer. Okay, so again, keep readapting. Okay, keep readapting, and again, always realistic with the market, no hoping everything is done based on the rules. To be honest, the rules that we use to manage those trades are copy paste of the rules that we use to put those trades in place at the beginning. So it's kind of easy to manage, but definitely the danger is that because you have a lot of time to think about it, you may start finding excuses. This is basically human trading psychology. You may start finding excuses to not to do something or do something else or get creative. And the challenge here, it's maybe because this is not intraday trading and it's very relaxed. The challenge is that maybe you end up not doing something and you procrastinate, or you end up doing too many things, too many adjustments and too many things, and you get in trouble. Okay, so make sure you keep it simple. But if you have to do something, you just do it. Okay, you don't just wait and nothing happens. Okay. Cool. So that would be the action to be done on Facebook. I see no questions, so then I would believe that everybody is clear on Facebook, or maybe you are actually implementing these changes. I know some of you are on this trade, so hopefully all clear. And if that's not the case, I'll say it again. Make sure you type it. Okay. Now, the next one we have is Philip Morris. Okay, so let's take a look at Philip Morris. So with Philip Morris, the P&L again shows here as negative. It doesn't mean it's negative. Okay, so we'll talk about that in a minute. But remember, we do multiple rolls, and the P&L that we see, it's the real-time P&L without counting, without taking into consideration all the prior rolls or tweaks that we have done, and therefore, the P&L is just like the real-time P&L with what you've got. But remember, Philip Morris and AFL are two trades where we have closed and locked in profits already. So the net P&L of those trades should be way better, maybe even profitable. So we'll see. Okay. So what's going on? Okay. Well, first of all, expiration is the 23rd of April. And here we have one of the options on Philip Morris, which is the 87 put that we sold. We collected 44 cents, and this one is currently trading at 8 cents. So 8 cents is a very low value, and I would be quite positive to think that we may be in a situation where we have to do another roll, because probably what's happening here is that we are dealing with those fake Greeks or distorted Greeks. Maybe it's a better term. Okay. So again, this trade on Philip Morris uses 23 of April. Okay, 23 of April and 1st of April. So when looking at the 1st of April and looking at the 87, isn't it? Yeah, 87 put. So the 87 put has a delta of 10 cents. Okay, 10 cents, where the midpoint is 8 cents. And we got, well, actually, Friday is a holiday, so expiration technically is tomorrow, to be honest. But even if expiration is tomorrow, so it's 2 days to go, and 2 days at a rate of 12, it's way more than 8 cents, right? And again, the most this option will lose is 8 cents because the midpoint is 8 cents. So how come theta is minus 12? And again, we talked about this before, so I will not repeat it. Those Greeks are now distorted, okay, because of how the expiration date is now so close. And therefore, it's time to roll by using the next expiration date, which is going to be April 9. Okay, if we do the April 9, we're going to collect 34 cents, okay, and that's going to, again, lower the cost of the trade and therefore produce a benefit, okay? So at this moment in time, what we have in this trade is, after all the rolls we have done, this is a trade that cost us $117, and therefore the most you can lose is 117. Okay, this is a trade where if we end up in the perfect spot, which is 87, we're gonna make $83. Okay, but as long as we stay between 85 and 89, then you will end up with some profit. Okay, the trade as we speak is basically breaking even, minus 1.5, even though on Thinkorswim it shows that the trade is minus 37 because we have collected premium as we have been doing rolls like the one we are about to do now. So this trade, again, it's in a break-even situation. It's not looking here. It looks negative, but it's actually break-even. Okay, so far not making money, not losing money, and we should see soon the increase of volatility as earnings are approaching, as well as we are about to roll and collect more premium. So we are about to really enter in a profitable territory in Philip Morris as well as AFL. Okay, it's a similar scenario. Jose, for this week expiration, it will be on Thursday, not Friday, because of Easter. You mean tomorrow? Yeah, exactly. That's what I meant, Ahmed. That's what I meant. That I said it's Friday, but I said, but this week is going to be 1 day less. Okay, so that's what I said. Thanks for that, by the way, because sometimes we get confused and we are human. And by the way, I trade in a different time zone. You guys probably know I live in Singapore, in Asia, and therefore sometimes I get mixed up with the dates that could happen easily, right? So I appreciate your comment because to me those sessions are I'm leading the sessions, but this is teamwork. Okay, so thanks for that. Okay. So anyway, so what are we gonna do? We're gonna roll. Okay, so we're gonna take that 87 put. I'm just gonna create a rolling order. Okay, and basically here what we're gonna do is we're gonna be buying back the 87 put that expires in April 1st and selling the one that expires in April 21st. Okay, this will help us to collect 32 cents. Okay, the midpoint was 35. The real, it seems to be more like 32. So whatever, we'll take it because we got distorted Greeks on the front week, isn't it? So it's time to move on to the next expiration date. And therefore, we are doing it right now. Okay, and let's see if we get filled on Philip Morris. Okay, while we're waiting to get filled, you can see those two boxes means that we haven't been filled yet. So you can see that the April 9 is still 0, where the April 1st is still -1. So the moment we get filled, it's going to be the opposite. Okay, but again, the moment we get filled, we will have collected additional 32 cents, meaning that the cost of this trade will no longer be 117. The cost of this trade would be, oh, sorry for that, I didn't do the math right. 117 minus 32, that would be 85. Okay, so what happens if I go ahead and change this to April 9 and I change this to 0.85? What happens if I do that? Well, if I do that, first of all, you can see that the most I will lose now is 85. Okay, and now the most I will make, it's, oh, here we go, 73. Okay, so it may look like a little less, okay, but remember, we are going to experience the increase of volatility. That will make a big difference. And again, we are in the same position of kind of break even, okay, but now the range is now 89 all the way to 85. Actually, we don't have a major difference in this particular roll. The only thing that really is showing improvement in this case really is the risk of the trade that went down from 117 to 35. You got filled at 28, Siderman. Thanks for sharing that one. Now, with volatility, again, we should expect, let me go back to the chart. Okay, let me load daily time frame. Let me load implied volatility of options. So we should expect, every time we got earnings, EPS postings. Here we go. So last time it was here. Okay, and right before there was an increase of volatility, you can see. Okay, the time before it was here, right? And right before there was an increase of volatility, right? So notice the increase of volatility hasn't happened yet. Okay, earnings are on 420. 420 is here, right? So from here to here, we should see that increase. Okay, so that increase, let's say it goes from here, which is 21, to let's say here, which is 30. That's 9% increase of volatility. So if we get that to kick in, which it should, so 9% increase on volatility, it's going to make the trade to, instead of break even, make $35 if price stays where it is. But look at the beauty of this. Now you could afford for the stock to move all the way to 91, or the stock to drop all the way to 83.5. So notice how the range has improved. But also, most importantly, now the most you will make is 130 instead of 70. So in other words, you have an increase of P&L if implied volatility was to go up, which is the bet from the beginning that we have. Okay, we are exposing ourselves to this range with a calendar because we are attempting to enjoy and profit and benefit from that increase in volatility, which is likely to happen. We are just building up until we get to that moment in time by reducing the risk of the trade, reducing the risk of the trade, reducing the risk of the trade until we get to that time. So if we get to that time, implied volatility rises, then we'll be able to leave the trade for a profit. Okay, so that's what we're doing. Okay, it's one of those approaches to trading where patience pay. To be honest, that should always be the approach to trading because we have no control over the market. So not to be patient, it's simply not reasonable. Okay. So anyway, so we got it with Philip Morris. It seems I haven't been filled. So you know what? Let's go ahead and do a little adjustment here. Cancel replace order. So I'm going to try 30 to see if I get it. Yes. Okay. Okay, now I got it. So I got it at 30. So really I need to update this. Really my cost is not 85, it's 87. So 2 cents more. Here we go. So I have it documented there for our follow-up in the following sessions. Okay. Got it. Perfect. And what's the next one? Well, the next one in line is AFL. Okay. So what's going on with AFL? Well, AFL is showing $45 of profit. So that's very nice. Okay. Because if the trade is already showing profit and we already did rolls and already collected profits before, so we should be in a nice profit overall. Now, maybe it's even time to close a trade. So we need to assess all of it. And therefore, we're going to move to AFL and see what's going on. So let me load AFL everywhere. Okay. Here we go. Well, AFL actually here shows us minus 1.5. Okay. And now I remember what happened. Actually, we are breaking even both with AFL and Philip Morris. The only difference is that when we rolled Philip Morris, we rolled for a profit. So now the P&L on TOA shows us negative, where when we rolled AFL, we rolled for a loss. So now the P&L shows positive. But if you add it all together, to be honest, both trades are still breaking even. Okay, so we are still playing patience. Okay, until that implied volatility rises. Now, same story. We are dealing with puts that expire in April 1st. So if I look at the 52 put that expire in April 1st, I would not be surprised if we get those distorted Greeks. Okay, and the answer is yes. We got $7 of theta, and you may be like, wait a minute, Jose, you got $85 of premium. Yeah, but not all of these will expire, isn't it? Because not all of these will decay, I should say, because the extrinsic value is only 5 cents. So 7 times 2 is 14, but the extrinsic value is only 5. Okay, and this is because that option is in the money. Okay, it's in the money, not like Philip Morris, which is out of the money. This one is in the money, and therefore, it's actually time to close. Okay, roll it, and go ahead and use the next one, which is going to be providing us with 112. So from 112 to 85, we're gonna, again, collect another 30 something cents or something like that. So let's do it. Okay, it's time to do it because we are dealing with those distorted Greeks. So create a rolling order on the short unit. 52 put. Well, that's, I didn't do the math right in my head. It's more 25 cents what we're gonna get. Okay, so buying back the April 1st 52 put and selling the new April 9 expiration 52 put for a total roll credit of 25 cents. So I'm just gonna do it. Okay, let's see when we get filled on that. Okay, so the order is in. Okay, you can see the two boxes here. So we're just waiting. But again, going back to do some analytics here, the moment we get the order filled, so basically what we've done is take this April 1st and make it April 9. And then what we've done is that 94 cents, okay, we reduced the cost of the trade by 25 cents. So now the cost of the trade is $69. Okay, and therefore we are dealing with a trade where the most you can lose is 69, the more you will make is 43, unless implied volatility rises, which is expected. I'm going to check out the earnings in a second. Okay, and now we are dealing with a range, which is a range going from 51 all the way to 53. Okay, so 51 to 53, that is the range where if price is in between, we're going to profit. Okay, unless implied volatility rises, where also the range widens. Okay, that's the beauty of the rise of volatility. Not only the P&L rises, the range also widens. Okay, so we increase profits and probability both. Okay, that's why I am making those trades so properly aligned with the earnings dates, precisely to try to not to miss on that increase in volatility, as it happens most of the times as earnings approach. So when I look at AFL, okay, and I look at the last earnings report, which was here. So right before the report, right before the report, we had an increase of volatility, okay, and then it dropped. If we look at the prior one, right before the report, we had an increase of volatility and then it dropped, right? So again, in this case, we're talking about April 28, okay, April 28, which is going to be somewhere here, okay? So volatility is absolutely crazy low, and this, by the way, this should be a bad tick, okay? It's such a weird, data on the screen, so it's probably a bad tick. But again, from here, volatility should rise, okay? And if you think about it, like from here to here, for example, okay, so it went from 28 to 30 something. So again, let's say that it's going to be a 10-point increase. So again, a 10-point increase in volatility would bring this range to go from 54.5 to 49.5, where a maximum profit now of 95. And now the trade would be in profit by 26. Okay, so hopefully these simulations, even though they are simulations, okay, we don't know how much the implied volatility will rise, because that's again, it would be, we need a crystal ball for that. But at least those simulations, hopefully they help to understand how these trades work. Okay, how these trades work, so we can go ahead and be prepared. Okay, cool. Ahmed, you don't like tradestation. Okay, well, to me there are pros and cons. For the charting part, actually I do like it very much. For the options part, TOS, I would say, is a superior software. And there is another software that I will start using soon that you are gonna love, which is even better. Okay, but again, I don't want to add too many things at the same time, because I would end up confusing you all, guys. Okay, so one step at a time. So going back to 55 minutes. Here's what we got. Let's see if we got the roll or what. Maybe what I'm going to do is to try to replace the order with a little bit less of a demand. Here we can see, the liquidity is not the same, 25 to 10. So here you have to play patience, big time. I just want to make sure I get filled, because that will really help the future sessions that we run. So okay, so I just drop it a couple of cents. That will make the trade $2 more expensive. So again, if we don't get filled, I'll do it again. until we get filled. Okay, cool. Okay, so we have it, my friends. So time to begin. Okay, and again today, based on what I said earlier, given the current market conditions, where the S&P is about to start making all-time highs again, and with the climate and the UFOs forming, is looking like it could be a nice consistent push. So I would like to look at some stock opportunities to see if we can just go ahead and execute some type of a trade. Can we give it until tomorrow? Yes, definitely. But I will just raise a word of caution there, Maca, to get filled at those prices. When you see a stock that has options that are very liquid, waiting until tomorrow is definitely the way to do it. So you get the price you want. So not a problem. But when you see a stock that is lacking a little bit of liquidity, and in the case of AFL, is not that amazing because you saw the midpoint and the natural point, 10 cents to 25 cents. So you can tell that there is a little bit of lack of liquidity there. So then what may happen tomorrow is that because tomorrow is like Friday, right? Really, today is like Thursday, but tomorrow will be like Friday. So you may have those spreads widen even more. Because now the market makers don't want people to get out of trades if those trades are going to end up for a loss, because that would mean a profit for them. And again, I'm happy to wait as long as it's 1 to 2 days prior to expiration, but waiting all the way to the expiration date to roll trades often would put you in a position where next thing you know, you need to use a market order, you get killed on slippage, and then the roll doesn't even help. Okay, or you end up with a naked unit because you never got filled until the end of the day. So I would say, let's keep trying to get it today. If you don't get it today, so certainly you can continue the try tomorrow, but you may be getting in trouble, okay? Because tomorrow, on top of that, being the reason why expiration is tomorrow is because of a holiday. So tomorrow actually may be a low volume trading day because some people already go on holiday. And again, the problem I just explained may even be worse, okay? So let's not be perfectionists. I am a perfectionist, and I keep slapping myself on the face every single day of my life to remind myself, don't be that perfectionist, okay? Sometimes it's better to miss on a few cents, but you get what you need instead of just want that price and just go for it. Again, in a normal case, I would say it's okay because tomorrow is still Thursday, but tomorrow Thursday is like Friday. So, I would be persistent on getting the fill today. Okay, that's the long story short. Cool. So let's begin our analysis, guys. Okay, looking for opportunities for potentially beautiful trades where we would make all-time highs with specific stocks. So FedEx here is definitely a candidate that we could use and explore. Now, problem: 46%. Does not allow me to do a directional trade. I need at least 50%, and we don't have it with FedEx. So I'm going to move into McDonald's and see what we have. By the way, I didn't say it, but I'm looking at my scan for long opportunities. Sorry for that, I forgot to say. So with McDonald's, I'm just not going to do it with McDonald's. The reason why is the climate in this case. The statistics suggest that 6 candles on the way up is normal. We've been moving 17 candles on the way up. So definitely that market is overstretched. And could it overstretch even more? Definitely. But again, probabilities are not suggesting that's the case. So taking the trade would be hopeful. We don't do that, isn't it? What about UMP? Okay, what about UMP? So with UMP, let me look at regular session. We got 51%. So that's good. What else do we have here? Pre and post market, it's 40%, so that's not valid. So we need to work on regular session. And with UNP, not only I have the probability I want, from a climate point of view, okay, we are dealing with statistics that suggest that 6 candles is a normal thing to happen, but we are in candle number 5. So either today or tomorrow would be both valid days for us to enter the trade. And if we were to enter a trade to the long side, what we want to do is to enter around 217, which happens to be this particular UFO between 218 and 215. We got 217 in there, isn't it? So definitely we have a setup. Now, if I look at the monthly time frame for UMP, that stock is about to start making all-time highs. So if the stock starts making all-time high, and that is supported by the S&P, which is also making all-time high, and we got a valid entry with a climate that allows for at least an initial push and maybe a couple of days of slowdown, with the climate going from kind of blue to unconfirmed red and then back to blue, then you have another 6 days of push. And again, this could be a very nice, very profitable trade if that's the case. And by the way, if this UFO was not to work well, in this case, this is just a bonus. Okay, we don't need it, but that's nice to see. So if that UFO doesn't work well, the next UFO is likely to push it up. Okay, and if that's not the case, the next UFO is likely to push it up. So again, we got lots of reasons why looking at UMP as a valid candidate for us to do this trade is valid. Okay, so all of this is in our favor. There's one thing that I'm not too fan of. Okay, Siderman, how many bars do you have selected on your chart? You have the same. It's 1597. That's the amount of bars I got. Okay, 1597. So the one thing I'm not too happy to see is the fact that earnings are happening on April 22. Why am I not too happy about that? Well, because the options that we're about to buy may be already a bit too expensive, even though the scanner is taking care of that and making sure the options are not so expensive. But I do have that thought in the back of my mind because earnings approaching may be a problem. So I'm going to have to be very careful there because, as we know, different expiration dates have different implied volatilities associated to that expiration date. And, we want to use the expiration date, which is aligned with earnings, to benefit from that rise in volatility, isn't it? So maybe it's a bit too late. The good news is that because the VIX has been going down and the VIX is 19, so we may still find reasonable premiums to do this trade. And we're going to get the answer to all of this by looking at the option chain. Now, in recent times, we've been running pretty complex option strategies in the room. Right now, what I'm about to plan, unless I change my mind as I see the option chain, I'm about to plan a very simple strategy, which is basically buy a call. That's it. Okay. Why? Well, because we are making all-time highs, so I cannot set a target, and potentially it may just go and go and go. So if the options are reasonably priced, so I would be happy and keen on exposing myself to just a long call, which is the simplest trade you could do. But then if the directional movement was to happen, then that would pay amazingly well. Okay, so I need to check all of this, okay, and see what we've got. Sorry, I just hit the wrong key on the keyboard. And again, we are talking about April 22nd. So the earnings date that we would want to use is the 23rd of April. Okay, and as you can see, the 23rd of April got 27% volatility. Okay, 27% volatility. And I'm just checking. So we got 27% volatility if we buy this one, but and definitely the prior ones, 21 and 23. So you can see that this expiration date has the earnings built in, and it's a bit pricey. I'm just looking, guys. But you can see how, and that I'm not surprised that volatility is now going down, 26, 25. But then in May, we got another increase of volatility. So, this kind of makes me feel that 27 is not that expensive, right? Because while it is more than 23 or 21, there are other expiration dates with the same values. It's not like this expiration date, it's overly inflated because earnings are priced in and any other expiration date is cheaper. It's not the case. There are other expiration dates that have the same level of volatility. So again, the scanner, picked the symbol for a reason, but again, options is a bit more complex than that, and I always like to look at the different expiration dates and confirm that's the case. So I'm okay, to be honest, with exploring an opportunity to buy a call on that particular stock. Okay, so I'm just going to analyze and buy a single option and see. Okay, now for me to buy a call on that stock, this stock is currently trading at 219.76. I'm not going to buy the call now. I would need to see the stock to fall and reach our UFO located at 218.20. Okay, so 218.20, that would be our entry point. Okay, 218.20. That would be our entry point. And at that entry point, the 220 call I selected would provide a delta of 46. Okay, that is not ideal. Okay, that is not ideal. We normally like to look at deltas around 30. Okay, so if I was to look at 222, that's 40 delta. If I was to look at 225, that's about 30. Okay, and that would be a trade that would cost about $300 over if the market was to come here. Okay, so again, if the market drops to 218.20 and we buy the 23 expiration 225 call, we're gonna have to pay $300 over, and then if it goes, we can make an unlimited amount of profits depending on how far it goes. If it goes against us, the most we can lose is 300 something. So again, this is a very, very simple trade, but definitely it makes sense. Okay, definitely it makes sense. And this is our entry point. Okay, we plan the trade at this particular moment in time. So what I'm going to do is I'm going to place an order to execute this trade. Again, this trade took a couple of minutes to plan, isn't it? We are not used to that in recent times where I've been adding a lot of different possibilities in trading. This one is just buying a call. That's it. And so what I'm going to do now is to place the order. So I'm just going to go for trade UNP April 23. We are buying the 225 call. Okay, so buy single. Okay, so we have it here. Buy the single. I'm gonna make this to be. I could use a limit order. I could do multiple things with this. Okay, but what I'm gonna do is I'm just gonna go ahead and click on that settings wheel button, and I'm gonna do a couple of adjustments here. Okay, so first of all. Let me go ahead. To keep it simple, okay, I'm just going to make it market price. And then what I'm going to do here to avoid a bit of slippage is to make sure that, and by the way, we have it as a day order, okay, yes. So this is a day order, okay, guys, important. So we have it as a day order. So I'm going to make sure that we are being filled anytime during today. Yeah, the market. Yeah, sorry guys. I was just thinking. Many times being in my time zone, I will place trades during daytime, which the U.S. market is closed, and many times I will use time conditions to avoid slippage. But in this case, the market is open. We want to get filled today, and the remaining part of the day is fine. So we're just going to use a price condition where if UNP drops to 218.20 or below, okay, then we want to activate this order to buy, okay, to buy. So I'm gonna click save, okay, and I'm just gonna go with confirm and send, and we can review it here. So buy one of the UNP 23 April expiration 225 call if UNP is at or below 218.20, okay, and again, if you do it at current price, it's 370, but we calculate it's going to be more around 310, 315. That's what is expected, okay? So I'm just going to click send, and this order is now waiting to get filled on the main screen, okay? But again, this is a day order, meaning that if we don't get filled today, then tomorrow we won't see UNP here. If we get filled today, then tomorrow we will see UNP here as a trade, okay? Good. By the way, I'm gonna tweak one more time, couple of cents less, my rolling order with AFL. So hopefully I will get it. And to be honest, given the lack of liquidity, something that often helps to get filled when options are not so liquid is instead of using prices such as 0.21, is to use multiples of 0 or 5, like 0.20. That often help very much in the real world to get filled more easily. Okay, so I have the order there. Let's see if I get filled. Okay, so back to AFL. I want to update the fact that I am selling that option for 3 cents less, which is going to make the price of this trade 3 cents more expensive, which is 74. Cool. Okay. So we have reviewed everything and we had our first trade of the day. So what I'm going to do now is to disconnect from the public spaces. Thank you for joining me today, guys. If you're in YouTube or Facebook, we'll see you tomorrow and continue the session in our private room looking for